Hello people, this is Dr. Wang here recording. Now we are moving to chapter 14, dividend policy. On the survey I posted on the Canvas for extra credit, I asked you guys to ask me questions about stock market. And some of you asked me whether a lot of companies pay dividend. The answer is yes. I did a Google search and I found that 84% of companies in the Standard Poor's 500 index pay dividend. Standard Poor's 500 includes the most liquid and largest companies in the United States, 500 of them, so you can treat them as the best 500 stocks, and 84% is quite large. This data comes from FINRA, which is a financial industry regulatory authority, and this is a very high-end organization to give the data. And back to the chapter. Why do firms pay dividends? Of course, the firm would pay dividend if they have the cash, and also the investors want to get paid periodically for their stocks. So right here, if you look at a firm, they first get the investment from stockholders. So the firm sell stocks to the investors, and then the cash go to the firm. And when the firm makes money, of course, they're going to pay tax to the government, and that they also pay dividends to the stockholders. And definitely, the investment banks play a role here when the stock is issued. So what kind of dividends are available? Well, they are not just cash dividends paid to the shareholders. There are also some other kinds of dividends. The most common ones we see usually is regular cash dividends, which is delivered on a quarterly basis. And there's also extra cash dividends. Let's say the firm never ever paid a dividend before, and then they have accumulated a lot of retained earnings from their net profit after years of operation, and they have nowhere else to deal with that cash. So they just pay off those cash to the shareholders as a one-time dividend. So this is called extra cash dividends. And one big example is Microsoft. In 2004, they paid 32.6 billion cash dividend to their shareholders. And that was like $3 per share. At that time, Microsoft price was like $24. So that's quite large one-time dividend. And there's also stock dividend. Stock dividend does not pay cash at all. So it's not coming from company's retained earnings or cash account. And no cash leaves the firm. The firm simply increase the number of shares outstanding. They inflate the number of total shares and pay the actual shares as dividend to the stockholders. As you can see, there's no value created by stock dividends. And in some extreme case, the firm may liquidate some of their assets, like selling some branches overseas they cannot operate anymore. And in that case, they would get a lump sum cash from liquidation of assets, and this would be paid to the shareholders. And this is called a distribution from capital as well. And for some companies, they just pay their shareholders with their products. Like a gum company just send their shareholders boxes of chewing gums, and a cremation company, they just offer shareholders discounted cremations. I'm not sure if I want to be a shareholder for that company. So what would happen to stock price when dividend is paid? Well, we follow the rule that the total wealth of the shareholders do not change due to cash dividends. Let's say in a world with no taxes, all right, no taxes at all, the stock price after the dividend will fall by the amount of a dividend. So basically, you have a higher stock price before dividend, and after dividend is paid, your stock price would drop accordingly by the same amount of the dividend. So your wealth before was one stock price, and your wealth after is another stock price, the lower one, plus the dividends. So your total wealth does not change, and the stock just fall exactly by the amount of a dividend. And this happens in a world with no taxes. So what happens if there's a tax? Well, that's also simple. The stock just fall by the amount of after-tax dividend. All right, so once the dividend is paid, there is a dividend tax to be levied on the cash. So you just get the after-tax part of the dividend. Still, the principle is not violated. your total wealth stays the same after the dividends. The only difference here is that the difference of the price is the after-tax part of the dividend. Does it matter whether the firm paid dividend or not? Essentially, it does not matter because whether the firm pay high dividend or low dividend, the investors can just replicate whatever dividend amount they want. I know this sounds a lot of abstract, so let me explain it. For example, if you want your stock to pay $3 dividend and the company just to pay $2 dividend, all right, just $1 short, and you are not satisfied with that. So what can you do? You just sell off some of your stocks to get the cash you want. And in another example, if the company pays $4 dividends and you only want $3 dividends, well, the company paying you too much, right? Then you just use the extra $1 dividend to reinvest in the company stocks. Use the $1 to buy the shares, and then your total stock holdings would increase. So the bottom line is whatever homemade dividend you create here, no matter using the extra dividend to reinvest in stocks or sell some of your stock shares to get more cash, the wealth, your total wealth, does not change at all. So the dividend policy will have no impact on the value of the firm, all right? No matter they pay too much dividends or they pay too little dividends, you just not worse off or better off because your total wealth does not change. This echoes what I just said. Any payout dividend is the same, and the investors can basically achieve their preferred level by making their homemade dividends. So either by selling shares to get extra cash, or if they receive too much cash, they reinvesting the dividends to buy the shares. Well, the dividends I talked about was cash dividends like what Microsoft did in 2004. And if the company have that large amount of cash, instead of paying cash dividends, they can also buy back their own stocks. And some other students also asked me in the survey, so when do the companies buy back stocks, buy back their own shares? This happens when the company has a lot of cash, of course, and that's called a stock repurchase. Between 2016 to 2019, the stock market increased by a lot, and the major force there was the repurchase of stocks. When the company received a lot of cash, then they use the cash to buy their shares. So what happens when people buy shares? Of course, the price would go up. Where did the firm get the money to buy the stocks? That's another question. It actually comes from the quantitative easing policy by the Federal Reserve. So the QE, or the quantitative easing, has a result of a lower interest. So it is cheaper for the companies to borrow money. So when they have the cheap money, they can use the money to buy back their shares. So that basically created a stock boom over the recent period. So if we compare stock repurchase versus a dividend, here is an example. Let's say we have a company. In the simplest case, the company has $150,000 cash and other assets is the $850,000. The total value of the firm is $1 million. And let's say this company is a fully equity financed, so there's zero debt. There are 100,000 shares outstanding. So from this table, from this balance sheet, you can basically calculate the stock price per share. You're going to use the total equity here divided by the shares outstanding, $1 million divided by 100,000 shares. That's going to give you $10 per share. All right, so that's one thing you need to do when you see questions like this. And then when the company thinks the cash is too much, they're going to get rid of $100,000 cash. So don't worry, the cash still belongs to the shareholders, just from one place to another. So right here, you see the cash got reduced by 100,000. Previously, the cash was 150, and now it's 50. Previously, the firm value was 1 million, and now it's 900,000. And of course, your total equity would reduce by the same amount. So what happened if that $100,000 is paid as cash dividend? And then, as I mentioned earlier, the stock price would just drop by the exact amount of a cash dividend. So $100,000 cash used for 100,000 shares, that is $1 per share for the dividend. You see, you have this $100,000 divided by this 100,000 shares. So for each share, there is a $1 dividend. And how much was the stock price before? It was $10. All right. So what would be the stock price after? It's 10 minus 1. The before dividend price $10 minus $1 dividends. So the after dividend price would be this $9. And that's fairly easy to calculate. And here it teaches you another way to calculate the after dividend price. You're going to use the after dividend equity. You see, when cash left the company, the assets got reduced, the equity also gets reduced. So the overall equity after dividend is going to be 900,000, and the company still have 100,000 shares, and the price per share would be the total equity divided by the total shares. That's $9. So this is another way to calculate the stock price after. And what happens if the company used the cash, the same cash, 100,000, through a stock repurchase program? So they are going to use $100,000 cash to buy the shares. And we know that before this stock repurchase, the stock price was $10. And now the company is going to use $100,000 to buy the shares, each at $10. Guess how many shares they can buy? It is going to be $100,000 here, the extra cash for the repurchase, divided by $10 per share. And then how many shares will be still available? So you had 100,000 shares minus 10,000 shares, so that's 90,000 shares. So the 10,000 shares is the stocks bought back by the company, and the 10,000 shares come from $100,000 divided by $10 per share. And what will be the stock price per share? In the stock repurchase program, please remember the stock price does not change, unlike cash dividend. The stock price still is at $10 per share. If you check the total equity, well, just like cash dividend, your total equity shrinked by $100,000, and your shares outstanding, total number of shares, is still 90,000. So the price per share is still $10. So if you compare stock repurchase versus a dividend, the company has the same balance sheet before and after. And for stock repurchase, the stock price is still the same. The shares outstanding is less after the repurchase. And for cash dividend, the share outstanding is still the same, but the stock price would be lower after the cash dividend. So I hope you would remember this trend. So what are the pros and cons? If the company has the money and they want to rid of the money still belongs to the shareholders, they use stock repurchase, and that's a pretty flexible for the shareholders. The companies are not obligated to pay to buy back the shares, so they can do it or they cannot do it, or they can use the cash to invest in some promising projects. And also, if the company fears the stock price would go down due to cash dividend, they would choose to do the stock repurchase. As I just demonstrated, after the stock repurchase, the stock price does not change. So that's going to keep the stock price higher. And that's good for people, especially the managers or the top shareholders, the stakeholders who hold stock options. Because for stock options, the value also increase with the stock prices. And there's also tax benefits for share repurchase. If the company pays a dividend, then there will be a dividend tax levied by the IRS. And sometimes, especially in the old times, the dividend tax is pretty high than the tax for the capital gains. If the company does not pay cash dividend instead of doing repurchase, that's going to drive the stock price high. And then you still get taxed for high stock price because you are making money from a higher stock price, right? And that tax is called a capital gains tax. And what is capital gain? It is basically the percentage change of a stock price and a price only, excluding dividends. And the formula of capital gains was mentioned in chapter 7, the stock chapter. I'm not going to cover that again here. Theoretically speaking, there is no difference between stock repurchase and cash dividends. Theoretically speaking, of course, and the theories, in order to exist, there has to be assumptions. And those are three big assumptions and some unrealistic assumptions. First, there's no taxes. So if there's no dividend tax or capital gains tax, it's the same to do stock repurchase or to pay cash dividend. And second, no transaction cost. And third, no uncertainty, meaning no risk. However, the capital gains can be deferred, and that gonna make tax rate of a dividend higher than the effective rate on capital gains. Let's say even though the capital gains tax and dividend tax are at the same level, but for the capital gains tax, it can be deferred. Meaning, if you are having some stocks and that's earning capital gains because the price gets higher, you can delay cashing out the shares, selling the stocks, or you can combine the selling of the stock with the selling of some other stocks which has loss. So you have a capital gains, you have a capital losses. So this combines will reduce your net capital gain, and you will pay tax only on the net portion of a capital gains, which could be lower if you combine a losing stock with the winning stock here. However, that's not the case for dividends. No matter the stock is losing or winning, you always pay the dividend tax. And I hope that makes sense to you. And this example is actually inspired by one of you guys who asked me a question whether how to avoid capital gains from their stock holdings. Well, the capital gains can never be avoided. That's the federal law, but it can be deferred. You can combine your stock with some losing stocks. Well, I don't hope that exists. The losing stock exists in your portfolio, but if it does exist, that actually provides some tax benefits, which would reduce the capital gains tax on your current stock. But still, in the real world, a lot of companies pay dividends, and there is a desire from investors for high dividends. From the behavioral perspective, investors prefer to receive a periodical cash flow. All right, so that would force them to be disciplined. If they get all the cash, a one-time lump sum, big cash, then they would just spend it, buy luxury things, or go to casinos, and that's not good. If the cash is paid periodically, then they are more behaved financially. And also, from the agency problem perspective, well, agency costs come from the previous chapter. That basically means the managers are wasting company cash at the expense of their shareholders because the cash actually belongs to the shareholders. So the high dividends would reduce the free cash flows, right? So cash is paid as dividends, and there would be less free cash flow for the managers to waste. So that basically effectively prevent agency costs. And also, paying dividend is a good signal for the firm's financial health. And if the firm suddenly quit paying dividends, so definitely that's a disastrous information about the firm. And the pros and cons of a dividends here. So if the company pays dividends, it still sends a good signal to the shareholders that the company is sustainable, that would attract investors and also absorb excess cash. Well, this can also be applied to stock repurchase. And what would be the cons for paying dividends? First of all, dividend tax is high, and in the old times, higher than the capital gains tax, and the dividend tax cannot be deferred. It cannot be canceled if you combine other losing stock in the portfolio. And also, if the firm pays too much cash for dividends, then they would not have the money to invest in good projects. So when the opportunity presents itself, if there is a very attractive opportunity that needs money for the company to invest in, then after paying all the cash, then the company would just get the money from external investors, like issuing debt or issuing stocks. And also, if the company is used to pay dividends periodically, then it's very hard for them to cut dividends. Usually, for a healthy company, the dividend can only go up. It can never go down. If it cut dividend, then that's definitely a bad news. All right. So if we are a rational and professional manager, then we should tell the firm that we never forgo positive projects, the positive NPV projects. So basically, that means the profitable projects. In the capital budgeting chapter, we know we use NPV to measure a project's profitability. So if there's a good project, like investing in a casino, let's say only from the financial perspective, that's very lucrative, then the firm should do it. And also, the firm should avoid issuing stock to pay dividends. And in a later slide, I will tell you that if stock dividends are paid, it does not help stock price. All right. Basically, you have more shares floating around, but the total wealth is still the same. So what would happen to the price per share when you have more shares? You actually have a lower price. So that's not quite good. And the firm can consider share repurchase when they have a fewer, better uses for the cash instead of paying the dividends. All right. And in the year of 2003, there was a change in the tax law. And that has a particular effect on the dividend tax. And that comes from the George W. Bush administration. And the president said double taxation is bad for our economy and it falls especially hard on retired people. And a double taxation is something I addressed earlier in chapter 1. That means for a company, they pay both corporate tax, and for the company owners, they also pay the income tax. And the income tax here is a dividend tax. All right. So this chart tells you the dividend taxes over the past 50 years or so. So in the 1960s, it was 90%. That's right. If a company pays $10 dividend, then you only receive $1. And the dividend tax rate gradually declined. And in 2003, there was a large decline by the Bush administration to roughly 15%. And if you look at the capital gains tax rate, it fluctuates, but it's more stable compared to dividend tax rate. And now both tax rates are similar at 15%. All right. So what happens when the dividend tax is cut? So if the tax rate gets lower, then companies are more motivated to pay dividends. So when the Bush administration cut the dividend tax rate, the companies just pay much more dividends. And remember that the stock price only dropped by the after-tax part of the dividends. All right, and here are some other tricks played by the companies. I call it tricks because it really does not create value for the shareholders. It's really about manipulating the number of shares, either using stock dividends or stock splits. I have talked about stock dividends. It's about issuing more shares and pay those extra shares as perks to the shareholders. And it's very easy to illustrate. If you own 100 shares of the company and the company just declare a 10% stock dividend, that means you're going to receive 10 extra shares. And of course, your stock price would drop accordingly, adjusted to the extra dividend, assuming your total wealth does not change. Well, stock split is like a stock dividends, and the stock split is expressed as a 2-for-1 2 is the number of shares after, and 1 is the number of shares before. If you have a 2-for-1 stock split, that means for every 1 share stock, it is split into 2 shares. It's not cut in half, it actually gets doubled. It's like the company pays 100% stock dividend, all right? 100% more means the number doubled. All right, and of course, after the stock split, the stock price would be reduced. If the stock shares increase by 100%, if stock shares doubles, that means the stock price would be cut in half. And Nike companies have done this a lot because their share prices just keep increasing on and on. If they don't do stock splits, they don't manipulate the share price, then the stock price would have just driven too high and it's not affordable to retail investors. There's also a trick called a reverse stock splits. Again, this does not create value to the shareholders. It's just simply making the shares less and the price higher. Instead of doing a 2-for-1 regular stock split, 1 share becoming 2, they do 1-for-2 reverse stock split. That means for every 2 shares before, now it just became as 1 share. So the number of shares is cut in half. What would happen to the stock price? Well, the stock price would double when you have less shares. And this would help increase the stock prices, and that helped the firm to maintain minimum stock price. And it also provides liquidity. And if the stock price is higher, it just earns respect from investors. Well, if the stock price is too low, what do we call them? We call them penny stocks or pink sheet stocks. And pink is like my shirt color. And these are basically a lot of bad firms. And here is one example. A company just had 24,000 shares of stock outstanding at a market price of 5.5. What will be the share price? What will be the share outstanding and the market price per share if the firm does a 3-for-7 reverse stock split? Well, 3-for-7 basically means for every 7 shares before, now it's shrunk to 3 shares. I know this ratio sounds unfriendly, but still we can do the calculation. So this basically means after the reverse stock split, your total number of shares will be 3/7 of the shares before. So you're going to use the 25,000 times 3 divided by 7, so you have less shares. The price will become more. It's going to be $5.5 times 7/3, okay, times 7 divided by 3. So that's going to be the new price afterward. And here's a last question, and it's very similar to your homework question. And basically, it summarizes some skills we learned in this chapter, and this is a short chapter. A firm has a market value equal to its book value. So based on the balance sheet, the book values, you can calculate the market price. That is what it's telling you. The firm has an excess cash of $800 and other assets of $5,200. So this would add up to $6,000 for the total assets, right? Cash plus other assets. So that's total assets, and that's $6,000. And the equity is $6,000 as well. So that means total assets equals to total equity. This is a 100% equity financed firm. And the firm has a 600 share stock outstanding, and based on that, you can get the book value per share. You're going to use the total equity, 6,000, divided by 6,000 shares, and that's going to be $10 per share, and that's the book value per share. It also tells you from the first sentence, market value equal to its book value. So if a book value per share is $10, the market value is also $10. Why do we need a market value? Because the stock price is a market value, and the company is going to use the market value of the stock for repurchase for cash dividend. And here it also tells you net income is $700, and this piece of information is redundant. You don't need the information of net income for cash dividends, stock dividends, or for stock repurchase. All right. And if the firm has decided to spend all of its excess cash, which is $800, on a share repurchase program, how many shares the firm will be outstanding after the repurchase is completed? Well, you need to know how many shares the company can buy back. If you have $800 and each share is $10 per share, 6,000 divided by 600 again, so $10 per share. So you can buy back 80 shares. Do you guys agree? So 800 divided by 10, that's 80 shares. And how many shares outstanding before? It was 600 shares that is reported here. So 600 shares before, now 80 shares purchased back, and what's the residual amount? It is going to be 520, and that's the number of stock after the repurchase.